Good morning and welcome. My name is Catherine Johnbull, and I'm the Chief Financial Officer of DLH Holdings Corp. We're on the NASDAQ under the symbol DLHC. I'm pleased to introduce you to the company and our journey so far and the future and where we're headed. We are a professional services firm supporting the major health agencies of the U.S. government. So think of Health and Human Services, of course, the health aspects of DoD and its military base, and public health in the scientific research organizations. So let me get this out of the way. This is the obligatory forward-looking statement. But getting into the company's, what the company brings to the market. As I mentioned, we are supporting the major federal health agencies, VA, FEMA, CDC, NIH, all those things that we've all been hearing about pretty much nonstop for the last 2 years through the pandemic. And we'll talk a little later about many of the things DLH has done in that regard. But we're delivering those services obviously through leveraging key technology components like digital transformation, AI, ML, machine language, NTP, all the things, data analytics, cloud computing, the things that allow the massive amounts of data relevant to federal health delivery and federal health policy to really be handled in a very efficient way through the use and the application of technology. And along the way, of course, as we're working with those key agencies, it's extremely important that we develop credentials as a company in our employees. Many of our folks have PhDs in various health disciplines or certifications of Masters in Public Health, and the things that are appealing to our customers and allow us to engage and resonate with our customers. But it's also important, of course, to have the company invest in the certifications that demonstrate proficiency and demonstrate reliability, particularly in the realm of cyber and trusted data and managing data on behalf of our customers. So you can see a further description of all those credentials on our websites and a demonstration of what we've accomplished over time. But going next to why we navigated, of course the federal government is massive and has many agencies, but why we navigated to the health markets is really, as the saying goes, why do people rob banks? Is because that's where the money is. From our perspective, the agencies that we're interested in are really those that enjoy stable markets, enjoy bipartisan support regardless of changes in administration, and really are addressing key issues for the general population, the voting populace. So health issues are key among that, and particularly, as I said, we all have a sharpened awareness of that here over the last couple of years. So the markets that we play in DoD health, the CAGR from 19 through projected 22 is relatively modest, 2%, but the distribution of DoD spending between military hardware and underlying health readiness for the fighting force has shifted quite a bit over to the health issues related to the fighting force. Within Health and Human Services, the expected growth rate in those budgets has been year over year relatively close to a 9% growth rate, and 9% within VA. So from our perspective, we are able to leverage the fact that we're operating in pretty stable markets that enjoy bipartisan support to really grow the company and provide a path for expansion of the results of the company. Our key investments here in the near term and as we're growing the company over time is really around organic growth. We're going to talk in a few moments around our history and our accomplishments on the M&A side, but really that was all with a view of really positioning the company and building a diverse platform that we could operate from across the spectrum of relevant federal health agencies so that we could be prepared to pursue robust organic growth. Presently, within our pipeline of opportunities that we're tracking and pursuing, the quantum on that is about $2 billion. The portion of that's $2 billion that we've identified as addressable by us, relevant to our capabilities, and actionable within the next 24 to 36 months. What's currently in process, as in there's a proposal underway and we're responding to it, is $800 million of that. So we believe that we've navigated to a place and prepared ourselves and acquired the capabilities through our acquisition program to be able to respond effectively to those very large opportunities in the federal health marketplace. This is a bit of a journey of our 5-year strategy that we just closed off on in 21. So the notion we implemented in 2016 was to take a business that was operating at around the $60 million level and really leverage the stability of the business we had in hand there, which was focusing in the VA market only, defense and VA, and really leverage that performance and our cash flow generation to grow the business and establish a foothold in the other relevant federal health markets in public health and in health and human services. So our primary focus has been market access, but a secondary focus on capabilities by adding technology through the acquisitions that we accomplished in a way that allowed us to grow the business from roughly something sub $60 million in 16 to we closed last year at around $250 million. So it's been you'll see later on the run out of revenue over the period of time that we've been operating solely in the government space. But this shows you that while we've accomplished acquisitions at the top and grown the business at the top line, we've also been able to significantly improve the operating results of the company. So we're now in context of the peer group that we've displayed here, which is, these are obviously companies that are about 20 times our size and pretty much household name companies that if you follow the government services space, you probably know these companies. But we've moved ourselves from being underperforming right up into the middle of the pack and very competitive with those much larger companies. And obviously that's been twofold as a result of being able to move up the value chain and do acquisitions that allowed us to take on more complex capabilities with a technology emphasis, but also the operating leverage that we achieved by growing the base of the business while not growing the infrastructure underlying the business at the same rate. While we've done that, the little run out of the icons at the bottom left really gives you the acquisitions laid out as they occurred. But the important thing to notice there is that as we were doing 3 acquisitions in the last 5 years, we've also grown the business organically 7% during that time frame. What's coming up for us now that we've accomplished our first phase acquisition program, which allowed us to get a foothold in all of the key markets in federal health? Our upcoming acquisition program is going to shift emphasis away from market focus, since we're now at least established and we have at least a workable presence in each of those markets and lots of headroom to continue to grow. We're going to flip our emphasis away from market focus and more over to capabilities. So we'll be looking to deepen our capabilities in those technology fields I mentioned, AI, ML, NLP, modeling and simulation, and the things that are relevant to our customers to run these very large-scale programs in the federal health sector. Obviously, a key part of that growth journey in the near term is going to continue to be attracting and retaining world-class talent. Everybody in the world knows that it's a very competitive labor market right now, and so really offering the potential for people to come in and join the company and really lead, drive growth, and assume leadership in a company that's growing quickly. That we believe that differentiates us and will help us in our pursuit of key talent. And then branching into adjacent end markets. While we certainly will not move away from our commitment to health as a primary market, we do believe there are a number of adjacent markets that are relevant and similar to the needs in the health space that we can apply our skills and our capabilities to expand our market presence in the federal market overall. So taking you through some financial highlights of the company over the time frame, we picked 13 as a marker because, and without taking you through the whole gory history story, the company itself was founded in '69 as principally a commercial company, and then had some challenges through the 2008 and 9 recession, so started to struggle and began losing money as a public company. This predates any of the current management. So the company made a decision to focus on solely the government space and divest all of its commercial operations. So a pretty bold move at the time, because at that time, government operations represented 5% of the company's revenue top line, but the profitable part of the top line. So they decided to divest the commercial operations, bring in management that was conversant and familiar with the government space, and give us the challenge to grow the business. And so I joined in 12. 13 was our first pivot to profitability, pretty skimpy profitability, but a start anyway. And so but that's why we picked 13 as kind of our launch point forward. So over the intervening 8 years since then, this is the journey we've been on to both grow the top line from, as I mentioned, roughly $50 million in fiscal 13 to $250 closing last year. And you'll see in a bit how we're doing so far this year. But in the meantime, as we grew the top line, then moving very smartly up the line on EBITDA margin delivery, which is what the yellow line is showing you. So over that period of time, the results delivered demonstrate a CAGR in revenue of 21% and an EBITDA of 70%. So from our perspective, we accomplished what we set out to accomplish in that first phase as we executed on that acquisition program. You know, from we perceive the market to be, it's demonstrably very much a consolidating market. And so we believe our imperative is to continue to grow. The history of the leaders in the company, none of us came here expecting to run a $250 million business. We're on a journey to get it to be a $500 million business and then beyond that. So our peer group, you know, when I attempt to find a peer group, these are all companies in the $2 to $4 to $5 billion range, and so we have a ways to go to be, you know, in that realm. But we're on our way, and I think we've done the hard part in terms of establishing a foundation in those relevant health markets, and now it's a matter of driving for growth and continuing to attack the market with the capabilities that we've assembled. As we've executed our acquisition program, we've been able to do that with essentially no dilution of the company. So we've accomplished that in obviously a very friendly debt environment. So we've been able to assemble a team of senior lenders that know the business, understand the industry, understand the challenges with the industry, understand the benefits of the industry being extremely cash flow positive, very low capital investment, all the things that make it easy to support levels of debt and quickly delever. So while we've accomplished our acquisition program with essentially no dilution, this chart demonstrates for you how quickly we peak. You can see the second bar is the peak of the last acquisition we did about 18 months ago, and we closed that with 2.8 times levered on EBITDA. We're now, as of the end of our last reported quarter, we're just about 1.25 times levered. So based on the cash flow that we generate, we quickly extinguish debt, and obviously that's our strategy for being able to reload, accomplish new acquisitions. We also, of course, as a public company, have access to the equity markets as a strategy for continuing to fuel outsized growth. But, you know, as I mentioned, we haven't yet needed to take that to lever that, pull that lever. We have substantial capacity. Our sense of, you know, the size of a deal we could accommodate or series of deals we could accommodate in the short run is it would bring additional top line of around $150 million. So that's the journey we're on. Where, on the other hand, while we have tremendous capacity to accomplish deals, we do think it's extremely important to be deliberate and strategic about the deals we're doing. So we're not really trying to grow just to roll up a bunch of top-line numbers. We're trying to be deliberate and thematic in fitting with our health and technology emphasis. And last slide, just to give you a bit of a preview or an update on how we're doing so far this year. So we took current quarter, most recently reported quarter's results, so the quarter ending in December, which is our fiscal first quarter. And we burst that. You'll see the dark purple bar and the light purple bar. We had a special event, if you will, in the realm of COVID support. So we had a very large contract supporting the state of Alaska in its response on a triage basis under a FEMA contract. supporting the state of Alaska as it was trying to address its surge. And that was a fairly short-term contract that affected our first quarter and the current quarter that ended, or the quarter that just ended in March. So it's a very relatively short duration, and so in that sense, I don't think of it as sustaining business, and really wanted to condition the market that, hey, this is a great icing on the cake, if you will. It's a big fat layer of icing, if you will. But it's not our underlying sustaining business, so I really wanted our investors to think about how we're doing in the underlying business, understanding that it was important for us to take that work in Alaska, not only it's a commitment, it's what we do. We care about health issues in the country in general, but also because it's important for us to demonstrate our ability to quickly marshal resources and respond to urgent issues in the healthcare environment. That's the essence of what we do. So being able to step up to the plate on that. And we placed in the state of Alaska just under 600 medical professionals in less than 2 weeks. So getting that assembled, getting that workforce marshaled, identified, marshaled, and deployed up to Alaska was extremely significant to them, and they were very appreciative of the effort. But nonetheless, from an investor's perspective, it's important that we think about what the sustaining business is doing. So this would show you that in our first quarter of our most recently completed and reported quarter, we did deliver in the sustaining business 7% growth in revenue year over year and 21% growth in our EBITDA. So it's a healthy business that continues to really look for ways to move up the value chain in terms of doing things that are increasingly complex and significant and differentiated, and typically translates to stronger margin delivery, and while at the same time continuing to leverage our operating model, and that translates to improving EBITDA over time. So that's a journey through what we've done so far. The rest of this is really just, the normal GAAP appendixes that give you the reconciliations of our GAAP results to reported EBITDA. So you can look at those in your leisure if you choose. And I will open it for questions. Yes, sir. Great questions, thank you. So the question was, I mentioned navigating to adjacent end markets, and also I disclosed that we solely work in the federal government space now, and is there an opportunity to work in other markets that are not federal government? So thank you for that question. So it's important for us to focus. We are still a fairly small organization. So we believe that the most likely next step would be other federal agencies. Federal government contracting has high barriers to entry because it's highly regulated, and so you don't just wake up one day and decide you want to do that. But for people like me who have been doing that for 25 years, I understand the parameters and the regulations and how to make sure we operate effectively within those. So the natural pivot would be over to similar federal markets. So a good example of that would be within Department of Justice and work for FBI, or within Department of Homeland Security and Workforce Custom and Border Protection. Both of those particularly have a component of health to it, but definitely have a strong application of technology to accomplish their mission. So those would be natural pivots. And that doesn't mean to suggest that the ones I didn't list are not targets of ours, but those are the ones that come to mind most readily when you look at large scale BPO operations on behalf of the government, applying technology with a healthcare flavor. Those are kind of the natural places to go. Beyond the federal market, the door is closed at the moment, but not nailed shut in terms of state and local. I certainly have in my background, and most of our leadership team has a stint at a contractor that had a state and local emphasis. But state and local, while many times the programs that are administered there have a federal funding component, they still operate differently state to state, and so you have to be prepared for the administrative cost of administering a series of 50 different programs. And so the prior speaker talked about the regulatory environment for cannabis and state by state and its variability. But certainly, the application of ACA, the application of healthcare requirements, and even the collecting of data and the administering of that is different state by state. And so, I think we will think long and hard about how prepared we are for that market, and if the right opportunity presents. We are doing some things that have direct connect to states, and so it wouldn't be a real far stretch to think about that as an opportunity. And then there's commercial. The company has a history of being commercial. It is obviously certainly a different sales model and different environment or regulatory environment for commercial business. And so again, doors closed at the moment, not nailed shut. If it makes sense for us to make that investment and build the resources, I think we would just need to do it with eyes open that you do have to understand it's a different business and you have to resource it differently. Thank you for that question. Any other questions? Yes, sir.
So I know that you guys are lower than year over year. So yeah, if you have an ability to expand into basic market here and M&A acquisition for the company, what's an appropriate leverage ratio you guys are comfortable with?
Good question, thank you. So the question was, in the context of M&A, what's the appropriate leverage ratio we're comfortable with? So I navigate to 3.5 as my outside boundary. Doesn't mean I wouldn't go above that if I needed to get the right deal that was meaningful for us and really strategic. But I start to squirm a little bit if you take me up over 3.5 times. We're unlikely to go over 4. And I think just the competitive market for lending is probably going to control that as well. But we're going to use debt appropriately and strategically to accomplish the acquisitions that we need to do to continue to move the company forward. Any other questions? Yes, sir.
So one of the things, the government oftentimes is significant contracts, major contracts. Could you talk a little bit about some of the major contracts you guys have where you are in the renewal process or rebidding process for those?
Sure, yes. So as a gentleman mentioned, we are certainly a collection of contracts. So we're fortunate to have a nice set of anchor contracts that really give us stability in the business and visibility. The typical contract in the federal government space is a 5-year contract. So once you get a renewal of that contract, you know that for 5 years, assuming you perform, and obviously we're motivated to do that, you're going to be secure and you have good revenue visibility for 5 years. We have the bulk of our revenue derived from relationships that we've had, or the acquired company that we brought into the fold has had a relationship with that customer for decades. And so it's important to build that intimacy with customers and really understand their needs. We do disclose 3 major, what we describe as major contracts that really drive about roughly 10%, not quite 10% each of our revenues. One of those is with Health and Human Services and renewed last August for a new 5 years. The second and third one are connected to the Veterans Administration, and there are 2 portfolios of contracts supporting the Veterans Pharmacy Program, where we're doing distribution on a daily basis of roughly 700,000 prescriptions, so about 130 million prescriptions a year to the veterans population, which, as you can appreciate, given the Afghanistan and Iraq and the recent conflicts, that population is continuing to grow, and the needs of that population are primary for Congress. So and rightly so. Obviously, we owe them a great debt. So those programs, we've had a relationship since 1999. It is a function of that agency that they tend to be overdue in their strategy to re-procure the work, and so we're currently operating in both of those programs under what's called a 1-year bridge, just renewing us 1 year at a time while they work through their issues related to their procurement strategy. So we're obviously confident in our ability to retain that work, as we've had it now for 20 years, 20 plus years, and we continue to invest in that relationship in a way that supports the needs of that customer. So I got the 1-minute signal, so I'm going to wrap it up. But I'm around all day and certainly available outside the door if anybody has any further questions. Thank you for your time and your questions.